New data out today on housing. June housing starts stronger than expected, driven by multifamily activity. Single-family starts and permits pulled back, though. Home builders have been on a tear lately. After June CPI report showed inflation cooling and boosted the odds of a Fed cut. So joining us now, Zelman and Associates Managing Director Alan Ratner. Alan, it's great to have you back on. That's exactly where I'm going to start, because we've seen this stagnation, stagflation, if you will, in the housing market. What shifts it? And what's contributing to the run recently we have seen in the home builder stocks?
Hey, Morgan, thanks for having me. The last several months, I would say the new home market has been pretty stagnant. The spring selling season got off to a good start earlier in the year. And right around March, April, we started to see things hit a little bit of a wall, not falling off of a cliff. But I think what we're seeing is the consumer is just struggling from an affordability perspective, with rates, albeit down more recently, still hovering in the high sixes. Prices are up a lot. And, at least from an employment perspective, things have kind of slowed down a little bit. So a little bit of a digestion period. What the market is showing right now, though, is a lot of optimism that the tamer inflation metrics are going to translate to much lower mortgage rates in the back half of the year and kind of solve that affordability problem. And that might be a little bit of an optimistic view.
Why is that optimistic? Because at most, maybe you get 50 basis points and it doesn't really change the equation that much?
Well, not to get too technical, but the bond market's already pricing in rate cuts. So the simple act of the Fed cutting is not necessarily going to have a direct impact on mortgage rates. Right now, the bond market is already pricing in that outlook. So, we'll see how far rates actually move lower. But our view is it's going to be a fairly gradual decline over the next several years, as opposed to a step function lower.
Alan, we talked a lot about supply lately, lack of it, and how that's affected keeping prices higher. But how does a weakening consumer potentially affect home builders? What about demand?
Yeah, it's a great point, John, because, the one thing that trumps lower rates is a recession. So what we've seen historically is a slowing economy, a slowing job market. That's going to overwhelm any relief we might see in mortgage rates, at least as far as fundamentals are concerned. The stocks might react in advance of that and kind of with the anticipation that the recession might be short-lived and ultimately Fed stimulus and lower rates will kind of spur demand and spur the economy. But, we are concerned about the direction of the economy and the consumer. And right now, if we can orchestrate a soft landing and lower rate environment, that is the Goldilocks scenario for housing, but it's definitely threading a needle.
Yeah, so far, so good, I guess. Alan Ratner, thanks for sharing your perspective there.